Welcome back to CanAg Unpacked. Back with us today, we have a tour de force in agricultural policy. Jack Wilkinson, former president of the Canadian Federation of Agriculture, former president of the Ontario Federation of Agriculture, and former president of the International Federation of Agricultural Producers, and recently retired as a director on the board of Canadian Cooperators. Welcome back, Jack. Then our special guest for today, FCC Executive Vice President, Strategy and Impact, and Chief Economist, Jean-Philippe Gervais. Welcome, JP. I assume we can call you JP even with a title like that?
Oh, absolutely. I've been JP for a number of years. It is actually a fun story about how I became JP, but that's for another day, I should say. So.
Well, welcome to the show. We may also have Wayne Easter, 28-year veteran of the House of Commons, former Attorney General, and longtime chair of the House of Commons Finance Committee. He may be joining us later, and we'll welcome him when he does join us. So, JP, what we'd like to do today is talk a little bit about FCC. Both Jack and I have a history with FCC. I kind of cut my teeth on FCC when John Ryan was the president. He did a really good job of working with the stakeholders, working with farmers, getting in the trenches with farmers. I remember one meeting I had with him in the CAP office in Winnipeg, and he says, "Bob, what do you think farmers need in the way of FCC programs?" We talked about environmental protocols on the farm, and I said, "Listen, there's not a big ROI on environmental protocols. Could you design a special program for environmental protocols?" And they got right to it, and in a couple of weeks they had one. So he really, I believe, put a really good face on FCC. Jack and I are also old enough to remember in the days when FCC was a lender of last resort. FCC has really grown from that. They made it through some very, very tough times, had to write off billions of dollars, but really are very competitive in the field now without government subsidies. I think we need to note that because academics, and when I say academics, I don't mean academics like you, JP. I mean academics that hide behind their pens have been quite critical of FCC, which they often are when farmers have an empowerment tool. And so, again, if you could tell us a little bit about FCC, that would be great.
So absolutely. Thanks for the invite. Really appreciate being with both of you today. FCC has changed a lot from the days that you alluded to, for sure. I mean, I think we've changed and evolved with the industry, right? So FCC is a federal crown corporation founded in 1959. At the end of the day, what we're doing is pretty simple. We're providing capital solutions to producers, so farm operators, as well as across the supply chain, right? The mandate is pretty clear. The mandate is to enhance rural Canada. So we're providing capital solutions to farm operations. We are as well helping industries that are connected to the farm, so upstream, so if you think of farm input manufacturers, retailers, and so forth, and working with them, providing capital solutions and so forth, and as well downstream, looking at food to help or support food processors grow, wholesaling, distribution, logistics, and so forth. So bottom line is, we have now a loan portfolio of around $54 billion spread across 80% at the farm level, 20% in those industries that are connected to the farm. And it's not just about capital solutions anymore. We are a software business as well. We are providing advisory services, working with partners. We're helping businesses figure out business plans, transition. So there's a number of different things that now FCC does beyond just the capital solutions to create value for the industry. So a totally different business now. We got an amazing strategy that we launched about a little more than a year ago. Under new leadership, our new CEO, Justine Hendricks. So I think we're pretty excited where we're at, and it's not to dismiss some of the challenges that we all are familiar with and we'll probably have a chance to talk about. We got lots of challenges in front of us, but we think that the opportunities are tremendous when you think of the future of ag and food in Canada.
All right, thanks for that, JP. Before I go to Jack, if he's got any questions or comments, Welcome to the show, Wayne. I already introduced you in absentia, so people know who you are. And welcome, and looking forward to having you as part of the discussion as well. Jack.
Okay.
Yeah, with FCC, I mean, you broadened your mandate. You said you're still about 80% in basic primary production. What kind of are your long-term forecasts as far as growth? Are you going to try and keep that mix? Are you looking at other areas of business opportunity? I'd be curious in that regard.
So this was a really good question. So I think in terms of share of how we're supporting the industry, the 80-20 is probably going to be evolving a little bit. So we're looking to grow with farmers and farmer operations overall. We're looking to grow it probably at the same pace as the market. I think FCC is not there to be to gain market share or to grow itself. It really is there to make sure that the capital markets that are available to farm operations is competitive. And so I think that's the role that we have to play. So from a farm operations or primary production standpoint, in terms of the capital that we're deploying in that market, we'll always, that's the bread and butter of FCC, we'll always look to support. At the same time, we realize that we have, the buzzword in the Canadian economy right now is productivity. And then we hopefully have a chance as well to talk about the productivity challenge that we have in the industry. But we believe that productivity is not just a farm-related issue. It's also along the supply chain. So we have to work all together. And financial institutions have a big role to play in making sure that, our productivity in Canadian ag and food remains top-notch in terms of to realize some of the opportunities that we have in front of us. So bottom line is, we believe that we can help by providing capital solutions upstream. So if you think of innovations, for example, in Canada, we have a deficit when it comes to innovation. So we're doing well. Don't get me wrong, right? Our productivity is still going up. We're still growing, the ability that we have in producing more food, using less inputs, doing it in a sustainable way. All true. I want to make sure that I emphasize this. And then we're top of the class. The issue, though, is that we're not keeping up with past rate of increases in productivity. Our growth slowing down, and we released a report, and that must be like now a year ago, where we basically said, hey, if we were to recapture the growth that we had in early 2000 to 2010, and even prior to this, the decade of 1990 to 2000, which we were growing productivity in agriculture in Canada about a rate of 2% on an annual basis. If we were to be able to go back to that, that's like $30 billion worth of farm income that you would put back in the pockets of farm operations. That's over 10 years. So that's $3 billion a year roughly. So it's not small change when you think of, return on assets in Canadian agriculture that's been always low, and we're a unique industry. We take a lot of risks, very highly capital intensive, yet our return on equity, return on asset is very small compared to other sectors of the Canadian economy. So for me, I think it's all about productivity. And so the ability for us to deploy capital outside of the primary production in areas of farm inputs, value add opportunities for our primary producers to sell their products to food processors in Canada, add value in Canada, export the food that we know the world needs. I think to me those are the opportunities. So I see that as a little bit of the growth that we have in front of us, yet always respecting that we're here to support Canadian ag and rural Canada.
You mentioned value added. I remember when FCC had to seek special legislation to go into value added or downstream. I also remember there was some criticism about FCC going into downstream financing or value added. I was part of CFA at the time, and our response was kind of, well, if a farmer wants to build a golf course on the back 40, that's diversification. That may be a safety net program. Why not allow FCC to be part of it? I know there was criticism about FCC financing a vineyard for a former Martin cabinet minister. How has your value added gone?
Well, tremendous growth. I mean, if you look at the last year, we just closed our year March 31st of 2025. So some of the numbers will be released pretty soon. But I mean, the growth that we've had in value add, I think it speaks for the numbers speaks for themselves in terms of the ability for us to really have a role in expanding the demand that Canadian producers face. To me, that's all there is to it, right? So I'll tell you this little anecdote. When I went to, this is like now almost a year ago, I went to the Ag Symposium of the U.S. Federal Reserve System. So it was all prior to all the trade disruptions that we face and whatnot. And I was blown away to see that in the U.S., I mean, they have scale, which is like, right, their industry is bigger than ours, just the sheer size of it, that's fair. But I was blown away by the consensus around whether it was primary producers, food processors, input manufacturers, whether it's crops, or livestock, so forth. I was blown away by the consensus around developing additional sources of demand. Because they were looking at, again, prior to this whole trade disruption stuff, prior to the election of President Trump, they were very skeptical of China being a source of growth for them in terms of the demand for their commodities. And they're looking to expand in terms, and then most of the focus of the conference was around energy. So to me, whether it's we want to grow energy and the use of feedstocks, or try to build renewable energy and have a role for the farm economy and building and securing our energy supply for the future, whether it's about value add, to me it's all about making sure that we expand the set of opportunities available for primary producers, because if they face higher, stronger demand, same thing goes when you think of exporting and you think of opening foreign markets. Now obviously the discussions about diversifying away from the US, but to me, that's all that there is to this, is that, how can we work all together, break silos within the Canadian ag and food supply chain so that we can all work to develop new sources of demand. And I think ultimately, everybody benefits from a very strong supply chain at all levels of the supply chain. We can, I could go on and on about how the need to innovate and then just to ramp up innovation upstream, right? When you think of inputs that farmers use, right? The more productive the inputs that they use is, the more profitability is going to be at the farm level. And ultimately, that's what matters, because more profitability allows producers to invest in their business. And that's like it builds a virtuous cycle of profitability and growth. So I think at the end of the day, that's what there is behind the strategy here.
Let's take the scenario where we do diversify our export markets, which for me is an opportunity here. The whole question of where do we go with retooling the processing industry, I think, becomes important at that point. It's an opportunity not to export so much raw material. Whether it turns out that way is an interesting question. But I mean, I think there will be some challenges getting the European market. I think it would be a great opportunity. I guess I also look at the opportunity of import displacement. If in fact we're going to open up transactional activity with Europe, are we going to have more product coming in from dairy and other products than we're going to be exporting in? So is this again an opportunity to your processing conversation of, can we move into some of those markets? Let's not assume that they're going to be taken by another country. Why not presume we'll keep it for ourselves and also tool up to be able to export? So are you starting down that path? And it gives great opportunity, value-added jobs as well.
Absolutely, I'm nodding because I really like what you said about import displacement, right? So, because at the end of the day, I mean, the challenge in front of us. So, if you look at food, commodities is a bit of a different space, because we do have some commodities that are quite exposed to the U.S. market. But for the bottom line is that overall for commodities, we're pretty well diversified. We export in a lot of markets, but let's just focus on food to illustrate this. So right now, 76% of our exports of food products go to the U.S. Let's pick a number. I mean, we can debate the number, but let's go to 50%. Let's just say that it would make sense for us to diversify away, kind of manage risks a little bit of our exposures to the U.S., a little bit different. So let's go from 76% down to 50%. So that's roughly $12 billion worth of exports that we're looking to diversify. But what we forget, and that goes to your point, what we forget is that we import a lot of food as well. So we keep talking about internal trade barriers. What are those? Well, standards, whether it's labor standards, transportation standards, regulatory standards that are different across provinces. So if we were to able to harmonize this, because I mean, having different standards raises the cost of doing business, and if you raise the cost of doing business, it makes you less competitive, and then as a result, you might be looking as a buyer, you might be looking to go into another market. So if we were to take that 12 billion and we need to diversify and look at imports, we think that at least out of that 12 billion, we can replace that 3 billion of the 12, we can replace this with internal trade as opposed to just going in the U.S. So we'd keep imports from the U.S. away. And then, of course, though, we would have to change things. We'd have to, like I said, harmonize standards. We would perhaps have to think of a little bit more about infrastructure. We have to, there's a number of different things that we can do. But like the task now, at least 25% of our diversification effort can be, we believe, certainly accounted for internally. So all of a sudden now it makes a little bit of the diversification effort a little bit less daunting. And then the second thing is that, of course, we need the trade agreements and all, but we've done a lot with regards to trade agreements. So at the end of the day, I go back to what makes us competitive to value add in Canada, and I go back to the ability for businesses to be productive. Like somebody mentioned to me, and I like that was a bit of an aha moment. Like, oh, productivity is such a boardroom type of discussion. Absolutely, 100%. So you have to take it back to the farm level, the food processing level, and say, what is that? Why does that matter? Well, it matters because it makes you more competitive, lowers the cost of doing business, makes you more attractive to a buyer. And on top of this, if we can leverage the trade agreements we already have, I think we're going to be really good in a good spot. Despite all the trade landscape that's changing right in front of our eyes, right?
Hey, Wayne, you had a comment. Go ahead.
Yes, I did. I agree with much of what JP is saying, and I do chair the Atlantic Beef Plant board up here, which is a CFIA inspected plant, and I understand all the things you're saying about being competitive, productive, and the kind of competition that we're up against. But I want to come back to the original mandate of FCC. JP, I was a member for 28 years. And I appreciate and actually like the fact that FCC is into financing beyond the farm community. But my worry is, and one of the biggest complaints I always had about FCC is that they've kind of moved away from financing high-risk farmers and went into more security money flow, but partly because you got to make money now, which wasn't your original mandate. But that's my concern. Look, this system won't work unless the primary producers themselves are profitable, and I really think FCC has to keep that uppermost in their mind. That we have to be able to finance the farm community for the farmers themselves to be competitive in their industry globally. So that's my biggest concern is how do you emphasize the farm community itself? How do you finance the farm community itself so they've got the financial means to provide all that production for all the others in the value chain?
Yeah, and I did allude at the very beginning about our new strategy at FCC, and as part of Budget 2024, the federal government directed us to change. I'll simplify things a little bit. Change a little bit of how we would manage our own capital, right? So for every loan that we make, we need to set aside a little bit of that money to protect FCC and protect the balance sheet, set aside some capital, just like other financial institutions. And the federal government recognized that in order for us to grow and be more productive, and all three crowns face the same issues, so EDC, BDC, and FCC, we said, well, we're not going to direct you to hold as much capital against the loans that you're making. And so right then and there, that actually freed up a lot of capital that we can now bring, instead of just having it park on our balance sheet, we can actually bring it into the financial markets for producers to borrow. So that's number one. Second, because I do agree, like we need to take a little bit more risk so that businesses can grow. There's no sustainability without profitability. And with regards to that directive, we're saying as part of our new strategy, we're going to revise the risk appetite. So every financial institution sets a guidelines, principles of risk appetite. Then you found, what are the measures that we're going to actually look to use to actually make sure that we live within our risk appetite. And so we're going to be stretching. We already are stretching in a number of different areas. We got a program called an EDGE program, which is basically saying that, if farm operations don't meet one of the three basics criteria, whether, it's collateral, cash flow, and so forth, we're going to take another look and bring them under an EDGE program that will allow them to actually finance. We also have a partnership, and I want to make sure that to emphasize this, because I think it's important. It's not just about FCC. It's about partnerships. We have a partnership that we announced some months ago now with Glengarry Finance, which basically is let's make sure that Glengarry Finance can have access to FCC's capital so that we can backstop some of the lending that they do. They have a very niche market for businesses that, again, are either starting new businesses and so forth, don't have the track record that you would normally expect. Different reasons. Now FCC can actually work with that partner. They have an expertise in getting that done. But then by FCC getting involved with that partner, we are lowering the cost of their capital, and they can actually pass this on to producers. So 100%, the focus of FCC is always going to be at the farm level. Like I said, no sustainability without profitability. I think that to me is a necessary condition. And looking to actually grow the industry and taking on more risk.
So, JP, what is your multiplier factor on your profit? If you make $40 million, how much can you leverage that for new loans?
So like 10 to 1 would be the ratio if you look at our balance sheet, like, an annual report and so forth. Like, for, I would say roughly, for any dollar of a loan that we make, we probably have to set aside the 10 cents. So it's like in terms of capital that we can deploy, our capital ratio will be about 10 to 1. So the profits that FCC makes are, some of it would be sent back to the federal government as our shareholder in form of a dividend. And a lot of that profit is also reinvested. So we have a number of different programs, whether it's our Ag Expert platform, whether it's which is a software, farm management software, whether it's advisory services. We've done many more advisory services or advisory assignments last year than we ever done at FCC, and we're going to continue to grow this. Like the profits that we make out of are reinvested through knowledge, and it's been reinvested into the industry and farm operations that don't have to be a customer. You don't have to be an FCC customer to attend an FCC event or to purchase an FCC software or to go and say, well, I'd love to for example, to benefit from any type of knowledge products that you have, any offering. So that's how we are reinvesting the profits that we make.
Before I go to Jack, just a quick question. You got a moratorium on paying corporate income tax because you had to write off so much. I think it was sometime in the 80s. And I remember lobbying the federal government to extend that moratorium, but that's quite some years ago. Do you still have that?
Yeah, we're not paying any taxes as part of the status that FCC has, within its legislation.
Okay, Jack, go ahead.
As Bob indicated earlier on, I just retired off the Cooperators Insurance Board, and I chaired their sustainability committee. And as you can well imagine, insurance companies pay a lot of attention to the weather risk portfolio worldwide in Canada. And I mean, without getting into a debate over climate change, I think it's pretty obvious when you look at reinsurance graphs internationally and Canadian claims on disasters, the numbers are really going up exponentially. No one has to get into the debate of why, but we certainly know that the facts there. Obviously, farm agriculture production is totally reliant on the weather, other than being in a greenhouse scenario. And so that really does change the risk portfolio looking out into the future from a farm point of view. What backstop is crop insurance going to provide to them? That varies by province, the degree of coverage they're able to get. You indicated you're looking at your risk portfolio. If you're going to move your risk portfolio a bit to the riskier side, then the farmers you're lending money to, that's part of your risk portfolio as well. So how do you soundproof or kind of proof them for being able to handle more climate risk? And I guess the other piece for that is we're not sure where the U.S. is going to go with its trade policy. I hope they never get into the time period where they dump internationally their products because they can't use it all domestically in a street fight like what existed 35 years ago. But, there is always that potential of a downside risk for both commodity prices, and there is at risk a down price for yield protection with climate impacts. So how are you looking at that? Where do you see that going?
So a couple of things with regards to your question, if you think of climate risk. So one of which is from FCC standpoint, and the other one is from our customer's operation, right? Well, obviously, the two are being linked. If we work with a customer, then we obviously take it on some of the risks as well. There's a risk-sharing agreement in some ways when it comes to a loan. So, from FCC standpoint, we're spending a lot of efforts in terms of understanding whether the credit risk models that we use to assess risk actually are still, we want to make sure that they always are relevant to account for the risks that are in the environment. So climate being one of them. So we've done a number of different things. We are obviously now, for example, always trying to forecast what farmland values are going to look like. Our corporate plan, so our strategic plan goes, we're doing this 5 years out. So there's always the requirement to do forecasts 5 years out. So as you imagine, it's pretty humbling when you look down, look back, and I always say all models are wrong, some are useful. So we want to make sure that the models that we use are useful to assess risks. We're never going to get it 100% right. When it comes to climate, we are deploying a lot of efforts, as I said, to make sure that the credit risk modeling that we use are still reflective of the environment. Climate does have an impact, as you pointed out, through an indirect impact on yields, and then revenues, ability to service debt, and all of that. Are we confident that the credit risk model? So that's the efforts that we're doing on an ongoing basis, always kind of reevaluating and assessing do we have the right risk modeling tools to assess the risks that our customers face. From a customer standpoint, we want to make sure that if there's more risk, it's a shared accountability, right? It's not the financial institution standing there and saying, in my opinion, saying, hey, that's on you. You just have to manage your risk better, or you have to find ways to, kind of offload that risk to somebody else. So what can we do? Well, we do knowledge, advisory, and so forth. That's one way to level up, so to speak, the risk management plans of farm operators. The second one is, how can we deploy capital that not only going to make you more productive and profitable, but that will lower or will improve your adaptation with regards to some of the climate risks that you face, and so forth. So we do bring that part of the equation into how we deal with customers. Not only looking at this is what you can do to improve your bottom line, but is that technology or that new production practice or whatever that is, does that have an impact as well on the risk that you face? Because we both win, customer and FCC, if customers implement risk-reducing technologies or technologies that will mitigate some of the risks that they face. So bottom line is there's a lot. This is an area where that is evolving. We are now, so this is going to be the second year where we have a climate risk disclosure report that is part of our commitment to live by the financial regulations that are asked of financial institutions in terms of reporting and disclosure. So we're doing a lot of work, but this is an area where data, I mean, I was talking about our Ag Expert platform. From a data standpoint, this is just wonderful because we now are able to tell our customers that are software users that here's your carbon footprint. So we are bringing in models that were developed by scientists at Ag Canada and the federal government, integrating that as an add-on. So customers don't see it's all in the background. They don't have to be aware or know how this all works. But when they go and log in into our software platform to look at their bottom line, look at what their seeding and so forth, they also have in the corner a carbon footprint estimate, a sustainability type of indicator that would tell them where they stand and so forth. So that's the first step. Data is so critical. The modeling. There's just a number of different things that I think we need to sort out as an industry that's going to take us, unfortunately, maybe a few years. But I do think that we're advancing with the industry. And again, I mean, the industry is the one telling us what they need. It's not about FCC saying you need to do this or that. Let's talking about our strategy. Well, the strategy is about the industry. It's like if the industry isn't on board with what we're trying to do, then that wouldn't be right. And so we want to make sure that we're producing or delivering and supplying what they need.
You have a follow-up for that, Jack?
Well, it's interesting because a number of the major food processors have indicated that they're going to move to sustainable agriculture production, various stages. For example, we grow a lot of milling quality oats in Northern Ontario where our farm is. We're doing a program with Quaker right now where we will be, PepsiCo, where we will be basically putting a plan in place for sustainable production. And I think that's going to spread across the country, product by product, which does add to an interesting scenario when both to what you were talking about, carbon, which is only a subset of that, but also trade. I mean, I think if we really are going to entertain growth and trade in Europe, some of these issues are still important to them. It gives us a trade opportunity. If we're ahead on that game, we may displace, for example, product coming in from other countries because we both have traceability, we got sustainability plans on our farm. The list of things goes on from the processing side. So it can be turned into an exciting business opportunity versus just a paperwork problem.
100%. And you mentioned Europe. I mean, they do have a border carbon adjustment that food's exempt of right now. But who's to say that some years from now, situation is entirely different? So 100%, I think, from a market access standpoint, I think some of the efforts that we're deploying with regards to sustainability, some of them are a pull from buyers, and I think also we have some efforts to do in terms of advancing our ability to document, and because I mean we're producing some of the most sustainable food in the world. I mean it's just what it is. I mean it's bottom line. There's a study that was done by the University of Saskatchewan that was looking at sustainability of some prairie crops relative to competitors in Europe, Australia, the U.S. We're far ahead in terms of sustainability than other countries. And so we just need to keep pushing, documenting, and so forth. And I do think it's going to open up markets.
Okay, there's two other things I would like to focus on a little bit, JP. I mean, I got to know you when you did a lot of the farm economy analysis, trade analysis, perhaps even agricultural policy analysis. So I'd like to touch a little bit on the farm economy. What is your perspective now when it comes to the farm economy?
So when you and I was in academia when we first our paths intersected, Bob, and I do remember those days very well. I was doing a lot of more policy then than I do now. Now this is more about making sure that we have the tools to convey to our customers and the industry in general, here's what the profitability looks like. Because as I said, all models are wrong, some are useful. So what can we lean on to make sure that, we are equipping our customers with the best tools that they can for them to make the decisions in their business. So if you look at the farm economy, there's the pre-Trump and post-Trump. So pre-Trump, we were going into a leaner year. No doubt. For crops, certainly. I mean, livestock, things were picking up at the end of 2024. I think we were starting for hogs, for example. We were starting to, well, and cattle is on a unique run right now, so that's positive in a lot of ways. Although profitability, everything's more expensive on the cattle side, so I think I'm not so sure that profitability is just off record highs though. But the bottom line is that we're on a good run. On the hog side, we had some difficult 2024, but towards the end of the year, things were turning a little bit. I think people were hopeful. If you look at dairy, a strong 2024, dairy was well positioned to have a good 2025, and I think for the most part, that's still accurate So there was a lot of optimism on the livestock side. Maybe on the crop side, though, things were looking leaner for sure. Like the margins already, we had seen commodity prices come down, and we were looking at margins that were below were below the 5-year averages for the 25 crop. Now, fast forward, we had the election at the end of 2024, and yes, tariffs were brought up at the time, but fast forward to now, early in 2025, so the discussions around the trade policy in the U.S., we ran some simulations that if you look at, a broad 25% tariff applied by the U.S., across the board, no exception. And again, it's just hard right now to keep track of what is tariffed or tariffied versus what's not. But let's just make the assumption that the U.S. would still go ahead with the 25% tariff across the board, all commodities, all products, and so forth, plus what we know is happening with China. This would have tremendous negative impact on farm net cash income. Even more so, a lot more so than the baseline that we were looking at prior to all the trade disruptions that we are talking about. So that makes it interesting because going into the year, we were facing productivity issues before Trump. We were facing lower commodity prices before Trump, certainly on the crop side, as I mentioned. So I think it all added a layer of uncertainty, which makes it really hard for businesses to plan. The one thing that businesses don't like to deal with, for good reasons, is the uncertainty. It's making investments, and certainly in the value add, true as well at the farm level, although I would argue that primary producers have a lot more long-term vision of where they want to take their farm operations. And so despite all the caution, despite all the uncertainty, if you look at by the end of 2024, yes, we had farm operations making fewer investments, but we've seen farm asset values go up because there's still a fairly strong demand despite all the different noise out there. So I'm fairly confident. I'm fairly confident of getting through this. I don't know, is it going to be 6 months, 12 months, 3 years, 4 years, 5 years? Who knows? Because I really believe in the fundamental. And the fundamental story of Canadian ag and food is that the world needs more of what we offer. Bottom line, period. The evidence is overwhelming that we need to produce more food. And who else to produce that food than Canada? We produce some of the safest, highest quality food, some of the most sustainable food in the world. So to me, I'm super optimistic, but I do think that we're going to have to navigate a period of time where margins are not going to be as high as we would hoped, and we're going to have to adjust, adapt. It's going to be highly volatile, but within that, there will be opportunities to market products. There will be opportunities to make some investments, and I think if we don't lose sight of the big picture, which is hard, I'm not certainly from my chair saying anything that this should be easy and then we just go invest. But really, I do think I'm very positive about the future outlook for the industry.
Well, I think the dynamics are going to be interesting in the U.S. because I believe MAGA farmers are already reacting to some of the impact of what's going on in the administration. So it'll be interesting to watch that. Jack.
Yeah, it will be, Bob. It's always our co-op in Northern Ontario is part of the GrowMart system. The Southern Ontario co-op's joined, which is $9-10 billion U.S. co-op in Illinois, the northern central states. And at a meeting just recently in Niagara Falls, there was a speaker from that system, an economist, and he said when the last round of tariffs came in with Trump, U.S. farmers actually made money out of the tariff war by the check written by the federal government. They got a check for $44 billion for that very short, limited time the tariff bump happened. So it's really, the U.S. government seems to have an incredible ability to cut a check to keep political peace, and so I don't know where that goes. It makes me worried, some of these things, because you don't like your old age to show, even though the photo says it all. But I mean, we got into a lot of trouble because of oversupply in the United States and loss of international markets. So they started dumping. You can start to see just hints of that sort of stuff, possibly, depending on where people going, happening again. We know that China isn't buying in at all with the volume that they were supposed to with the deal on the first Trump go-round. Europe is pushing back on the demands of the U.S. to bring in GMO products, as well as hormones and beef and the list of things. So, where does that take us if this really does ratchet up a little bit? So that's my kind of worry. I think it's a low probability, but I think it still is a probability that people need to think a little bit about. Not imagine a doomsday scenario, but in doubt, have more cash available. In doubt, have more equity available, because to your point, JP, it might be a bit of a rough ride.
Well, Jack, you and I
100%.
both heard the president of the American Farm Bureau say that farm subsidies was what gave them comparative advantage. That was at an NAEU meeting, and everybody almost fell out of their chair laughing when he said that, but he said it with a straight face. Go ahead, JP.
100% agree with the possibility that we are staring at a few highly disruptive years when it comes to profitability. Because, and to your point, the U.S. is going to bring production that supply is very inelastic because of different things, among which, for sure, the top of the list, the U.S. Farm Bill and U.S. policy. So farmers are not going to come back because they face more dire prospect of selling whatever commodities they're growing because of China, because of other different trading blocks. And so I do agree that at some point we're going to feel the pressure through lower prices. It's interesting right now that the markets did react in the early stage to chatter of Trump and 25% tariff and it's on, it's off, it's on, it's off. But now markets are mostly back where they were. It's almost as if they are kind of ignoring the noise. There's a lot of improv right now in the U.S. administration in terms of what that policy is going to look like. I don't think there's a very clear strategy of what reshoring manufacturing really means. Who's going to get, how are we going to build the plants? How are we going to build the factories? Who's going to work in these factories if you're going to deport more people? There's just tons of things that don't add up on the U.S. side. Bottom line, though, it doesn't mean that, the lack of strategy or foresight on their part, it might not hurt us. It will. It could hurt us in terms of more products coming into Canada, or as well with fewer export markets available for U.S. products. That has an impact on U.S. prices, and we're a price taker in the North American market for the most part, for most sectors. So that's what hurt us the first time around, during the first administration, where, let's say, let's use soybeans as an example. Soybean prices came down, but then the government was able to offset some of the U.S. government was able to offset some of the lost revenues with some program payments, that ad hoc program payments to offset that. We didn't get that chance, right? Our basis went up a little bit, improved a little bit, so that kind of made up a little bit. The value of the Canadian dollar came down a little, but there was never an offset of some of the kind of getting caught in a crossfire here of what happened. And I think that's certainly one of the risks, and the risks as well that, hey, we need to start thinking about other export markets.
That's a great segue into the last topic that I would like to cover, and we are running out of time. But I'd like to talk about trade opportunities. Our new Prime Minister has already said we will not be victimized by the U.S. We will find markets elsewhere if we have to. And thankfully, Canada was quite aggressive with the bilateral and plurilateral trade negotiations over the last 7 to 8 years, although, that was fortunate for exporters. Supply management, of course, had to sacrifice some TRQ space. But what do you think the opportunities are then in diversifying our markets?
Well, I think, we got a great challenge in front of us. It's not going to be easy. There's a reason why things go where they go and so forth. So for us to be able to, in a market, to diversify away from the U.S., will require to lower our cost of doing business one way or the other. So, and part of the platform that our new prime minister put forward. There's a mention of infrastructure. I do think that this is something, it's a really good time for us to think about this, how we're going to deliver more infrastructure and so forth. That remains TBD. But the bottom line is I think it's a good time. There's a focus on control environment, agriculture. For some areas of the country, it makes sense. So there's a number of different things that we can think about as well. I go back to we've opened up new markets. If you look at the trade deals, and then there's a long list of trade deals now that we have signed. Some of them are signed, not implemented. But the bottom line is we have more market access than we ever had. So to me, it goes to the exporting decision starts at the farm level. It starts there. So if producers have access to cheaper inputs, more productive, more drought-resistant seeds, more different types of fertilizer, like all of the entire suite of different inputs, I think that's going to be a step in the right direction. And I go back to innovation. We need to have a more, like the OECD ranked us 25 out of 38 countries when it comes to our innovation policy environment. It's not good enough. I mean, we're not going to be able to develop new things, new products, new processes when we're 25 out of 38. It's just not possible. If you look at the AgTech, that's a very popular word right now, AgTech. Lots of different platforms, lots of different technologies, and so forth. But if you look at the U.S. versus Canada, the money invested in AgTech right now, the ratio is 23 to 1. 23 for the U.S. relative to, $23 for each dollar we have invested in AgTech. So the solution is not going to be as well 100% Canadian, because there's no way we can close that gap with like in a foreseeable future. So I think part of this is like, how can we commercialize some of the innovation? How can we de-risk the adoption of technology at the farm level, right? So, what are the programs? What are the capital solutions? Financial institutions have a role to play in de-risking. If we're able to bring in innovation into Canada and say, oh, and by the way, we have it trialed in different fields in Canada, and here's the data to show you that. And on top of this, we can perhaps de-risk with some sort of financial incentive the adoption of X, Y, and Z. I think to me that makes us more competitive and makes us more able to access those other markets, because like we'll have to move away from the U.S. We can't rely on the U.S. as much as we can say 3 years from now or 3.5 years from now, Trump's out of the White House, but economic nationalism is a thing. It's not just a thing south of the border. It's a thing in Europe as well. It's a thing elsewhere in the world. Trumpism might not die after Donald Trump's out of the White House. There's going to be ramifications of all that, those 4 years. So we have to get ready, and now is the time. We have the burning platform. So we don't have it now. I don't know what is it going to take for us to.
Yeah, I think the WTO is certainly toast until Trump is gone. But if you look at CPTPP, Trump may also be doing us a favor if he wants to pick a fight with Japan and Vietnam, for example. Then we don't have to compete with the U.S. On beef in those countries.
So just an anecdote, and I was at CIAL, which is the International Food Show in Toronto this week, and lots on trade for sure. And I got a couple of anecdotes that to me were like, So one of the things that Americans don't realize is that foreign buyers, are trying to move away from the sourcing the American products. Like if you cranberries, for example, like we got lots to offer. Foreign buyers are telling everybody that, hey, if we can move away from our U.S. suppliers, we will do so happily, because they don't see them as reliable. So we're talking China, we're talking other Asian markets. The second thing is, and I ran into somebody that has been in the food business for 40 years, and they said, what Trump did is the equivalent of dozens and dozens of millions of dollars invested in promoting Canadian food products. Like you've never seen Canadians respond. Like it would have taken huge marketing effort to lead retailers and consumers to adopt new purchasing behaviors the way that they have. I mean, there's some silver lining in terms of all the issues that we face, I suppose. And to me, I think that we'll get through this.
Jack.
Bob, I know we're just about done, but just one point to add on to that. What's happening in the United States over the last number of months and now in relationship to what they're doing to the regulatory system, what they're doing in a number of areas of traceability, of labeling, all of these issues, which for a foreign country, I think really gives us another opportunity. Like you say, we've got we have trust in our regulatory system. We've got great partnerships between government processors and farmers and commodity groups. We can meet the requirements of any buyer do already, and it stands up. And I mean, I think that's going to, if this continues in the United States, I really see that as a separation. I really think the U.S. is really hurting its ability, both with its own consumers, but internationally, as it continues to dismantle some of the regulatory and science-backed systems that we have in the United States, and that's going to be very interesting to see where that goes.
Absolutely, right? FDA and USDA are not the FDA and the USDA that we came to know for so many years now. Not anymore, and that's just lots of question marks there for sure.
All right, gentlemen, thank you very much for that great discussion. Thanks, Jack, for coming back again. And JP, I've always appreciated the papers you published on the farm economy, on trade, etc. You did well, I always loved them and appreciated them for their in-depth analysis of some of those issues. I suspect you have a lot of qualified people that now do the work for you, but I'm sure your finger is still in it. So thank you very much. And thank you for the things that FCC has, the opportunities FCC has given farmers. So we'll hope to have you back.
Thanks. Oh, it was a pleasure. Thanks for bringing this up. Thanks for the feedback. And I do indeed have an amazing team of economists behind the scenes that I am just lucky enough to celebrate the success that they're putting together. But FCC.ca would be the place to go if anybody's looking for knowledge on the ag industry.
All right. Thanks, gentlemen.
Take care.
Thanks so much.
Okay, thank you very much, JP. That was excellent.
Good. I mean, hopefully,